Hello, fellow investors. This is Iggy from the Investing Iguana. Today, we're diving deep into the financial performance of CDL Hospitality Trust's CDLHT for the fiscal year 2023. The title of our video today is CDLHT's FI 2023 Report Card, Rising Above the Challenges. In this video, we'll unpack the key financial indicators, explore the factors that led to their success, and discuss the challenges they faced. We'll also delve into the specifics of their performance in the Singapore market. So, if you're interested in understanding the dynamics of a successful REIT amidst a challenging economic environment, you're in the right place. Let's get started. CDL Hospitality Trust's CDLHT has shared some good news for its investors. For the fiscal year 2023, they have declared a distribution per stapled security, DPS, of 5.70 cents. This might seem like a small number, but it's actually a 1.2% increase compared to the previous year. The main driver behind this growth is an increase in net property income, NPI, which is the income generated from the properties after deducting property-related expenses. But that's not all. The total amount distributed to the investors, after taking into account the working capital, has also seen a rise. It has gone up by 1.8% to reach $71.0 million. A significant part of this increase, a whopping 99.5%, is due to the rise in capital distributions, which amounted to $12.7 million for the year. Now, let's talk about CDLHT's revenue for FI 2023. It has seen a healthy increase of 12.3%, bringing the total to $257.6 million. This increase is thanks to improvements across most of its portfolio markets. Following the trend of revenue, the NPI has also risen by 11.8% to reach $138.3 million. This increase is again due to the higher revenue and increased NPI contributions from most markets. However, it's worth noting that not all markets contributed to this growth. New Zealand and the Maldives were the exceptions. However, it wasn't all smooth sailing. Interest costs for FI 2023 saw an uptick, mainly due to higher funding costs on CDLHT's floating-rate loans and refinancing of its fixed-rate loans. These higher interest costs were also due to the amounts drawn to finance the group's asset enhancement works. In the second half of FI 2023, the DPS fell by 11.1% to 3.19 cents due to these higher interest costs. Similarly, the distribution to stapled security holders, after retaining working capital, also fell by 10.7% to $39.8 million. Despite these challenges, revenue for the 6-month period increased by 5.8% to $138.3 million, thanks to the continued recovery in global travel across all of CDLHT's market segments. NPI grew by 3.7% to $75.5 million, in line with the higher revenue and NPI across all markets, except for its hotels in Singapore and Perth, Australia. The lower NPI for CDLHT's Singapore portfolio was due to higher property taxes and increased operating costs. Let's delve into the concept of RevPAR growth, which stands for revenue per available room. This is a key performance metric in the hospitality industry. For CDL Hospitality Trust's CDLHT in Singapore, there's been a significant growth in RevPAR. In the fiscal year 2023, the RevPAR grew by 19% to reach $198. However, in the second half of the fiscal year 2023, the RevPAR saw a more modest rise of 3.5% to reach $217. This moderation in growth during the fourth quarter of the fiscal year 2023 can be attributed to a decrease in demand. Now, let's look at the average occupancy rate for CDLHT's hotels in Singapore. In FI 2023, there was a slight increase of 0.1 percentage points, bringing the occupancy rate to 76.2%. However, in the second half of the fiscal year 2023, the occupancy rate fell by 3.7 percentage points to 83.1%. The average daily rate, ADR, another important metric in the hospitality industry, also saw an increase. It rose by 18.8% to reach $260 for FI 2023 and grew by 8.1% to reach $261 in the second half of the fiscal year 2023. As we reach the end of the fiscal year on December 31st, 2023, we see that CDLHT's total portfolio value has increased by 7.8% to reach $3.2 billion. The Real Estate Investment Trust's REIT's gearing, which is a measure of financial leverage, stood at 36.7%. The interest coverage ratio, which is used to determine how easily a company can pay interest on its outstanding debt, was at 2.65 times. Lastly, the fixed-rate borrowings, which are loans with an interest rate that doesn't fluctuate during the fixed-rate period of the loan, stood at 52.3%. Vincent Yeo, who is the CEO of the managers of CDL Hospitality Trusts, CDLHT, shared his thoughts on the performance of the company for the year 2023. He acknowledged that the year was challenging. Despite the difficulties posed by the economy and the high interest rates, they were able to achieve growth, which is a commendable feat. He also touched upon the topic of international travelers, specifically those from China. According to him, these travelers have not fully returned yet. However, this did not stop the global travel industry from recovering in 2023. This is a positive sign for the future. Singapore, which is their core market, saw remarkable growth in its hospitality sector. This growth was observed in the first 3 quarters of 2023. This was not a sudden occurrence, but a continuation of the strong rebound that started in 2022. This shows the resilience and potential of the hospitality sector in Singapore. However, it's important to note that the final quarter of the year saw a change. The pent-up demand, which was a major factor fueling the resurgence of the industry, began to normalize. This means that the extraordinary demand that was seen during the recovery phase started to settle down to more regular levels. This is a natural progression as markets stabilize after a period of intense growth. Despite this, the overall performance of CDLHT in 2023 can be seen as a positive stride forward amidst challenging circumstances. Personal analysis from Iggy, the Investing Iguana. CDLHT's FY 2023 performance was commendable, with a 1.2% increase in distribution per stapled security, DPS, and a 12.3% rise in revenue. Despite higher interest costs, they managed to increase their net property income, NPI, by 11.8%. These figures indicate a strong financial position, which bodes well for the future. However, the second half of FY 2023 saw a dip in DPS and distribution to stapled security holders due to these higher interest costs. This suggests that CDLHT will need to carefully manage its financial obligations in 2024 to maintain its growth trajectory. In terms of market performance, CDLHT saw revenue per available room, RevPAR, growth in Singapore, its core market. However, the final quarter of 2023 saw a moderation in demand. This could be an area of concern for 2024, especially if the pent-up demand continues to normalize. On the positive side, CDLHT's total portfolio value increased by 7.8% to $3.2 billion in 2023. If this upward trend continues, it could contribute to a stronger performance in 2024. In conclusion, while there are some challenges ahead, CDLHT's strong FY 2023 performance and continued portfolio growth suggest a positive outlook for 2024. However, they will need to navigate the potential normalization of demand and manage their interest costs effectively. As always, it's important for us as investors to keep a close eye on these developments. And that wraps up our deep dive into CDLHT's FY 2023 performance. It's clear that despite the challenges, CDLHT has managed to rise above and deliver a commendable performance. As investors, it's crucial for us to understand these dynamics to make informed decisions. If you found this video helpful, please give it a thumbs up and share it with your fellow investors. Don't forget to subscribe to the Investing Iguana channel for more insightful content on investing. Remember, the more you know, the better decisions you can make. This is Iggy, signing off. Until next time, keep investing and stay savvy.